newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai, in for Francine Lacqua, and these are your top stories. Brussels delays retaliatory tariffs after President Trump threatens a 30% rate on goods from the EU and Mexico if better terms cannot be agreed by August the 1st. Stocks fall as Washington escalates its trade war, with investors bracing for a flurry of data that's expected to offer an early read on the impact of tariffs. Plus, President Trump says the U.S. will send more Patriot air defense batteries to Ukraine to help defend against Russian attacks. All right, let's get you up to speed on how some of these markets are faring. We are seeing S&P futures dip a little bit this morning, down 0.4%. We are gearing up for a major week in terms of data, with U.S. CPI coming out tomorrow, in addition to the kicking off of the earnings season. So watch out for banks' earnings this week. This as Wall Street downgrade their estimates for EPS growth year-on-year, lowest level since 2023. 10-year yields up 1.5 basis points today, 4.42, but building on from losses on Friday, we're up about 7 basis points as we keep a close eye on the inflation situation. Euro not doing a whole lot this morning, 116.86 is where we're at. And then Brent, we continue to see gains in the energy complex. Brent sitting at $71, up 1%, as we talk about the potential announcement from the U.S. later on Russian sanctions. But the main story today, European markets, as you can see, the UK is the outperformer, but the continental Europe, all a deep sea of red on back of the latest tariff threats and the possibility of European tariffs going up to 30% on August the 1st. Our top story today. Now, the U.S. president says talks with the European Union are continuing after he raised tariffs on the EU and Mexico to 30%. The higher rate will kick in on August the 1st if trade talks fail. The EU said last week that the framework for a deal was close and has extended the suspension of countermeasures while the talks continue. Donald Trump says trading partners must open up.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
All right, let's get more from Bloomberg's trade czar, Brendan Murray, trade czar. So you must be busy, Brendan. Maybe let's just start with the latest news this morning and the fact that the U.S. now has sent a letter to the EU. There's a real possibility of a 30% tariff rate. This despite the fact that the EU were attempting to have negotiations with the U.S. around a trade deal. What are the main sticking points?
Yeah, well, up until a couple of days ago, things seemed to be moving relatively quickly toward an agreement. But then we heard from the president this new 30% tariff threat, and that really is going to add new urgency to the discussions in Brussels that we're seeing today. And they are really under the gun now to figure out how much of an imbalanced arrangement are they going to be willing to accept, because they've already pretty much accepted it, that they're going to have some sort of reciprocal or universal tariff that they're going to have to withstand. But the real sticking points come down to what are the tariffs going to be on autos and steel and aluminum and pharmaceuticals, these sectoral tariffs that the president has threatened alongside these universal tariffs. So there's going to be a lot of discussions going on in Brussels today about whether they should respond with retaliatory measures, these countermeasures, to hit back at what the president is threatening, or whether they really feel like they have enough time to negotiate less than 2 weeks now before the new deadline.
Yeah, there's an interesting story up on the terminal today saying that the EU is looking to engage with other nations also hit by U.S. tariffs. And I wonder if that gives us some insight into how the EU could potentially counter these tariff threats. What are their options at this point?
Well, what a lot of these countries are coming to the conclusion of that these one-on-one negotiations with Trump, they're not going to win them. He is going to wind up with a tariff on your imports into the U.S. And so I think what we're hearing are sort of the early rumblings of maybe if we all got together and did this in a collective way, then that could be a way to stand up to the sheer clout of the U.S. economy that Trump is using as leverage. So we don't know whether there's some grand plan yet for countries to strike back together in the trade sense, but what we're hearing are a resignation that the U.S. is going into trade wars individually with all these countries, and all these countries can't fight back individually, so maybe they need to team up to do so.
Yeah, well, certainly it's having an impact on European markets today. Most of those indices down about 0.8%. Bloomberg's trade czar, Brendan Murray, thank you so much. Let's get more on the market impact. We're joined by Modupe Adegbembo, an economist at Jefferies. Good to have you with us. Earlier on the show, on the earlier shows, we had some comments come through from the European Trade Commissioner, and he essentially was saying that a 30% tariff rate would essentially disrupt trade between the EU and US. And we're talking about a non-negligible size here, around $400 billion worth. How disruptive do you think a 30% tariff rate would be for the European economy if indeed it does come to pass?
If a 30% tariff came to pass, I think it would be a real challenge for European manufacturers to deal with. I think one of the things that we also have to consider when you look at European exports to the US is that they're already kind of on the higher cost side. So they don't necessarily have a strong kind of buffer that they could erode into when you start to get to this level of 30%. I do think we hear people suggest that, if you get to the 10% kind of level of tariff, that's something that exporters could deal with. It would be a very big challenge to them, but they could kind of find ways, cost cutting and other ways of kind of saving funds that would allow them to absorb around a 10% kind of tariff. But yes, 30% becomes extremely prohibitive. And I think that's when you start to see a sharp reduction in exports, and that will have a real impact on the Eurozone economy.
Yeah, I mean, that's the thing, right? Like, you look at the ECB's GDP projections for this year, they're sitting at 0.9%, about 1.1% for next year. And over the course of the weekend, I've already seen growth downgrades come through if this 30% tariff comes into fruition, anything from 0.5% to 1%. Could this actually be the catalyst that tips the Eurozone into a recession?
Absolutely. I think it could be. And I think this is what we were kind of fearing, because we knew that the kind of trade negotiations would be difficult. But I think broadly there was an expectation that, we wouldn't necessarily see these tariffs being implemented. But if we were to see these 30% tariffs being implemented, I think there is a good chance that we could see a recession in the Eurozone. And I think particularly because of Germany, already growth in Germany, most people are seeing it kind of flat. That's where we expect it to be. We think Germany will really struggle to grow significantly this year, but a 30% tariff would make it a lot more likely that we see negative growth in Germany. And if the biggest country in the Eurozone is struggling in that way, it's hard to really, really see significant growth outside in other pockets.
Yeah. So it's interesting you mentioned Germany, because as we speak, German bund yields continue to rise higher. You look at 10-year bunds, we're up about 20 basis points over the course of this month. And if it's not necessarily to do with the growth outlook, because the growth outlook is dimming, is it because investors continue to price in a higher fiscal premium out of Europe and specifically Germany here?
I think we are seeing that. We're definitely seeing significant fiscal expansion. Of course, we've talked about the kind of infrastructure, defence, but also towards the end of last week, we saw the kind of tax breaks for firms also being implemented by the German government. So there's a significant fiscal expansion going on there. And I think it's taking time for investors to kind of, understand and get used to this new reality. It's a complete shift from what we've seen over the last kind of few decades. So it will still take time to feed through to markets. And of course, when we look across other markets, not just Germany, I think investors are really, really focused on the fiscal outlook. And even though I think Germany's on a much more solid footing, with debt to GDP around 65%, I think markets still are acknowledging that there'll be more issuance, more for them to take down, and that will have an impact on yields.
Yeah, I mean, there was a lot of commentary around 5-year OATs overtaking 5-year BTPs in terms of yield. And I just wonder to what extent the investor focus is going to move away from just focusing on the growth outlook towards fiscal premium, and not just specifically amongst European bond markets, but also in the US. You've got long end yields moving higher, and of course, JGB is the long end as well.
As we kind of move into Q3 right now, I do think that, potentially after the summer break, that's something that we see as a really key theme. As you mentioned, from the US, there's a lot more focus with more fiscal expansion on the US, but also we can see from the UK that there's been a lot of attention around fiscal sustainability. And I think what's important about kind of Q3 is that's when we really start to see more discussions around next year's budgets. And we've seen a commitment for a lot of European countries in particular to increase their defence spending. But the key question is how a lot of these countries that are a bit more constrained actually end up doing that. And so I do think we will see more and more focus kind of around the fiscal path and the fiscal outlook. And that is quite challenging because, at least from the US perspective, I do think there, of course, is a sharp kind of set to be a sharp increase in US deficits. But from the US perspective, there still is quite a strong growth kind of underlying drive, which I think is important. It's helpful from a fiscal perspective. But actually, for the Eurozone and for Europe in general, trend growth is lower. And so when you see these upticks in borrowing, you see this increase in issuance, it can have more of an impact on markets.
Yeah, Ned, can I just ask you what you think this all means for the ECB? At the latest meeting, the signaling was, I would say, a little bit more cautious or less dovish than it's been as of late. And I wonder whether the new information around the tariffs could actually incentivize them to once again turn more dovish again because of the worsening outlook.
Yeah, so in terms of the next kind of meeting, I do think there's a likelihood that we see more of a dovish shift from the ECB. The kind of risks around growth are beginning to crystallize. So a kind of weakening trade relationship with the US, the potential 30% tariffs will be kind of extremely important to their kind of thinking and their rationale at that moment. But I also think one of the things that we haven't talked about, but the kind of currency as well, the currency impact, that's something that ECB members have also been quite open and vocal, talking about the fact that a stronger euro is also going to have deflationary impacts. So, yeah, I do think we are kind of setting ourselves up to potentially see a bit of a dovish shift. And I do think we see the ECB deliver one more cut this year, so bringing rates to 1.75%. But I think the challenge for the ECB is that they also are very, very conscious of the fact that they want to essentially keep powder dry, because they have this fear around tariffs, which of course is true, but their worry is if they cut too fast, if the kind of actual outcome doesn't end up as bad as they are anticipating, have they done too much? Have they not allowed themselves enough room to maneuver? And I think that's one of the things that they'll be weighing up as well.
Yeah, no central bank wants to reverse course. Modupe, Adegbembo, an economist at Jefferies, thank you so much for joining the Pulse today. Now, coming up, as President Trump ramps up his global tariff threats, we'll speak to the foreign minister of Panama, a country whose famous waterway has drawn the attention of Washington. That's next. This is Bloomberg. China's export growth has accelerated for the first time since March, driven by demand from key markets and helped by the trade war truce with the U.S. Exports in June were up 5.8%, while imports rose 1.1%, both figures beating estimates. Let's get more from James Mager, Bloomberg senior Chinese economy and government reporter. So surprising data to the upside coming through from China overnight. And I wonder what sort of read across that has to the GDP data that's expected to come through tomorrow morning.
Well, I think the first thing to look at is that there was a $590 billion surplus in the first half of the year, which is a massive amount of money. It's a huge surplus. And that is really going to help drive growth in the data that we're going to get tomorrow. My calculation is it's probably about, that surplus is about 6 point something percent of GDP. And that is going to be a record in the data that we have. So even if the domestic economy is weak and you saw weak import numbers, that really strong export performance is really going to help push GDP probably a little bit higher than expectations.
Yeah. What could be the potential impact if things all of a sudden deteriorate once again? Because the truth or the language around the framework, things seem to be stagnating ever since it was achieved in Geneva or in London. If things take a turn for the worse again, how is that expected to show up in Chinese data in the coming months?
I think the first thing you'll see is a drop-off again in exports to the US. But the thing to really to look at in the Chinese trade data is that it's not just exports to the US. Exports to Europe are growing again. Exports to ASEAN are growing again. Exports to Africa at a record. South America. Everywhere in the world, at the moment at least, companies all around the world are trying to buy as much Chinese products as they can, whether it's EVs, solar panels, steel, toys, furniture, everything that China makes is going out the door. And part of that is, I guess, price deflation. These products are becoming cheaper because you have China itself is in deflation. But even if the trade directly with the US starts to shrink or falls because of these tariffs that we're seeing, it's really going to take a bigger shock where global demand starts to fall before you're going to see a real drop-off in Chinese export numbers.
Very fair. Watching out for those GDP figures then. Tomorrow, Bloomberg senior Chinese economy and government reporter James Mager, thanks so much. Now, European Union officials are meeting with the foreign ministers of Central American countries today as President Trump's tariff threat looms over Brussels. Amongst the countries attending the talks is Panama, which has been removed from an EU list of so-called high-risk regimes. We're joined now from Brussels by Panama's Foreign Minister, Javier Martínez-Acha Vásquez. Really good to have you with us. Good morning to you. You're talking to us from Brussels, so I want to start off by asking you about the significance of being removed from the EU's list of high-risk regimes. I'm assuming a lot of work has gone into this moment. How much of a milestone is it for Panama?
Good morning. It is a milestone indeed. We were removed from a list that we consider very unfair because Panama has shown through the years that we are a reliable partner. We have gone through a process of reform in recent years. We are a very, pro-Western country. We have a very solid jurisdiction in terms of our service economy. And the European Union recognized that by removing our country from such a list. And we are very glad, the horizons right now are very, very attractive for everybody, for the European countries, for European companies, and for Panama. We hope from now on to work closely with the European Union, with our partners, as well as with the United States, because we are committed to transparency and also to cooperate with the European Union and with all democratic countries that shares our values.
Yeah. Well, Panama, you mentioned the United States. Panama found itself at the center of the news a couple of months ago. And even on the campaign trail, President Trump talked about taking back control of the Panama Canal. And of course, your president quipped that sovereignty was not up for discussion. Can I just start off by asking you today, at this point in time, how is Panama's relationship with the United States?
Well, right now, our relations are very good. We have gone through a period of complex relationship, but so far, with the new administration in different levels, we have developed a very close and fruitful relationship. We have been visited by major officers from the United States, Secretary of Defense, Secretary of State, the head of the CIA, and also the Secretary of Homeland Security. That shows the interest of the USA in Panama. There is a fact. The USA is our principal ally in terms of commerce and also in terms of security. But this is a historical fact. It is not an event that has developed since the new administration in the USA. Right now, I can reassure you that we are working together in different fronts, in cooperations, to tackle organized crime, asymmetrical threat, but always with respect to our Constitution and to our neutrality treaty that guarantees the neutrality of the Panama Canal for all the countries in the world.
Yeah. What you haven't mentioned, though, is the links to China, and that is a serious point of contention that the U.S. has, especially the Chinese-linked infrastructure. On the back of your discussions with the United States, are you re-evaluating the economic arrangements that you have in place with China?
Well, let's be clear on this issue. There is no Chinese influence in Panama or in the Panama Canal. We do have 2 ports that were handed to companies, because the ports belong to Panama, at the end of last century. In those days, Hong Kong was part of the UK. And then Hong Kong became part of the People's Republic of China. So they are now part of that country. They have zero influence in the canal. They have a port operation within the canal in the Atlantic and in the Pacific. So I can, be very sincere and also make a steadfast affirmation that the Panama Canal is run by Panamanians in a very efficient manner without interfere from any country in the world.
A few months ago, there was a report that came out saying that BlackRock were reportedly in talks to acquire 2 of those ports under L.K. Hutchison's control. But recently, there seems to be some noise around it because of the uncertainty vis-a-vis the tariff regime between U.S. and China. Can you give us just an update of where things stand with those discussions?
Well, that is a private operation between BlackRock and MSC and the current owner, Hutchison Port. So I cannot comment on the negotiation because that's so far a private transaction. I believe the deadline that they established was at the end of July. When that deadline expires, our country will have the right to take some decisions in the best interest of Panama.
So let me just
Also,
go back to what I said to you at the beginning, which is...
It's very important to remark that BlackRock is trying to buy the whole operation of Hutchison Port in the world, not only the 2 Panamanian ports.
Yeah. Let me go back then to what I was saying about Panama finding itself as a geopolitical hotspot around the world. And now the news cycle has moved on. So many countries around the world are having discussions with President Trump. Is there any advice that you would give other leaders, foreign affairs ministers, in terms of how to deal with the Trump administration to move towards a coordinated response and one that is reliant on mutual respect and cooperation as opposed to mutual threats?
Well, you have to understand that the Americans elected Mr. Trump in a very clean elections, and he put forward his plan. So he's not doing anything else than what he promised. From that point on, we need to engage with the USA in a very sincere and frank manner, and the personal interactions really helps. I have had the opportunity to meet with different very important officers from the American administrations within the room when we explain to them our reality, our constraint. They are very, very, they comprehend what we are doing in Panama. We feel that the personal touch really help to develop a very strong and beneficial relationship between both countries.
Yeah, certainly. Appears to be good advice. Panama's Foreign Minister, Javier Martínez-Acha Vásque, thank you so much for taking the time to speak with us today from Brussels. Well, coming up, we will be taking a look into India's push into clean energy with the chairman and CEO of Indian renewable company Renew. That's next, and this is Bloomberg. Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai in for Francine Lacroix, and these are your top stories. Brussels delays retaliatory tariffs after President Trump threatens a 30% rate on goods from the EU and Mexico if better terms cannot be agreed by August the 1st. Stocks fall as Washington escalates its trade war, with investors bracing for a flurry of data that's expected to offer an early read on the impact of tariffs. Plus, President Trump says the U.S. will send more Patriot air defense batteries to Ukraine to help defend against Russian attacks. And a look at markets today. The big news, obviously, tariffs, the latest tariff threats out of the U.S. towards the EU and Mexico. S&P futures down 0.4%, coming off those all-time record highs. Big week coming up in terms of U.S. CPI and the beginning of earnings season. So watch out for that in the coming days. 10-year yields up about 1.5 basis points. Of course, we are up 7 basis points. We were up 7 basis points on Friday as we continue to put a lot of focus both on the inflation outlook and the fiscal premium amongst many yield curves around the world. Bitcoin, I just wanted to flag this morning, we are through $120,000 for the first time ever, so up 3% in trade, but notable because it is at an all-time record high. And then silver as well, it hasn't got as much love or as attention as gold, but today you can see up 1.3%, the highest level in 14 years for silver, so just sitting shy of $39 today. But back to one of our other top stories this morning. President Trump says the U.S. will send more Patriot air defense batteries to Ukraine, which Kyiv says are needed to protect against Russia's ongoing airstrikes.
I haven't agreed on the number yet, but they're going to have some because they do need protection. But the European Union is paying for it. We're not paying anything for it, but we will send it. It'll be business for us, and we will send them Patriots, which they desperately need.
This comes as Axios reports Trump will also announce a new plan to arm Ukraine, possibly as soon as today. Let's get more with Bloomberg's Russia economic and government editor Greg Sullivan over here with me in Dubai. Greg, what do we know about Trump's plans to assist Ukraine with its military equipment?
Yes, so President Trump has agreed to provide these Patriot missile barrages that Ukraine says they need for their protection. He wasn't specific about how much he would supply, but he did say that the U.S. would not be paying for it. They would be paid for by European and NATO allies. But Ukraine has said that they need these. The Pentagon had been supplying anti-air defense missiles and artillery shells, but then they halted it, saying that they needed to assess their own stockpiles. This appears to be a shift back to us.
Why has there been this shift in thinking from the U.S. president's perspective? Because it was only a couple of months ago he was ruling out the possibility of further military aid to Ukraine.
You're right. This is a big shift from President Trump. He's been very reluctant to aid Ukraine. He campaigned saying that he didn't want to. But there's a number of factors at play. One is that during his campaign in the first months of his term, he was adamant that he could bring about a peace deal. So far, Russian intransigence on that matter has frustrated him. To the missile and drone barrages over
And
Ukraine.
he also teased on Friday that there's a big announcement coming this afternoon. Some people have taken it to are inferring that it could mean another round of sanctions on Russia. What do we think?
It could be a number of things, but two things that we'll be watching very closely are weapons supplies. Are there more to this weapons delivery than has been previously announced? And two, as you said, sanctions. So far, he's been reluctant to impose sanctions on Russia, but this could be a moment to announce a shift in that. There's obviously legislation working through Congress that he might cast his support behind. So those are two things that we'll watch carefully in this announcement.
Greg, thank you so much. Bloomberg's Russia economic and government editor, Greg Sullivan. Now, Iran's foreign minister says the U.S. is trying to restart nuclear talks, but stressed his country is in no hurry to engage. He said in televised remarks that Iran had received multiple messages and is weighing options. He added that Iran needs guarantees it won't be attacked again if the talks don't succeed. And Jane Street Group has paid $564 million to an escrow account to comply with an order from Indian regulators. The U.S. trading giant deposited the funds after a ruling from the Securities and Exchange Board of India last week. The SEBI temporarily banned Jane Street over allegations of index manipulation, which Jane Street disputes. Now, India is making significant strides in its energy transition, embracing clean and efficient solutions to reduce its reliance on fossil fuels and imports. This strategic shift is crucial as the nation currently spends an amount equivalent to 5% of its GDP on importing fossil fuels. Joining me now is Sumant Sinha, Chairman and CEO of Indian renewable energy company Renew. Really good to have you with us on the program. Before we talk about your own company's plans, I do want to ask you perhaps a broader macro question as it pertains to India, because we know many countries around the world, India included, are having discussions with the U.S. about a potential trade deal. To what extent do you feel like the fate of your own company's operations are linked to what happens with those discussions and whether India can actually seal a deal?
Yeah, hi, thanks, Jumana. Look, I think that the Indian clean energy sector within which we operate right now is mostly domestically focused. We have a lot of growth in the Indian electricity system. We're growing at about 6 to 7% every year. And that's on top of a fairly significant market size, which is the third largest in the world. And so therefore, our company's future really is tied into the growth of the Indian market. We don't have that much essentially to do with the U.S., and so therefore, really, for us as a clean energy player, the trade deal with the U.S. really doesn't matter as much. Of course, we are also a solar panel manufacturer. So to that extent, to the extent that they are willing to import, or the U.S. is willing to import solar modules from India, I think that, of course, can then become an additional market for companies like ours, which are also manufacturing solar panels. But other than that, there is no real implication for Indian companies.
I was going to ask you about that, because the U.S. is looking to protect its industry from Chinese manufacturers. I do wonder whether Indian manufacturers actually sense a window of opportunity and economic opportunity to fill that void.
There might very well be. I think we have to look at the fine print of the big, beautiful bill to see exactly what it says around imports from other countries and what sort of imports are permissible and so on. And of course, we also have to see what the reduction in the IRA benefits that were there earlier essentially means for future capacity addition of solar power in the U.S. So I think we'll have to look at all of that, and I think some of that will become clearer in the next couple of months' time as the details of the bill are something that we begin to absorb and assimilate. I think we'll find out as we go forward.
Have you had to rethink your own supply chains and where you import your crucial raw materials from? In a world where protectionist barriers are going up, have you had to sort of rethink your own process of where you import some of those materials?
Yeah, absolutely. I think, what has happened is that the Indian government has taken a very strategic view that we don't want to essentially, exchange one kind of energy dependence, which is really today on oil and gas, to another kind of energy dependence, which is importing equipment for making solar panels or wind turbines from other countries. And so therefore, there's a very strong decision taken to essentially try to make sure that we localize and indigenize all the manufacturing for clean energy within the country itself. So wind turbines are mostly made in India. And solar panels now, we have a very active solar module manufacturing industry in the country. We're also making solar cells. And over time, the intention of the government is essentially to localize the entire solar manufacturing chain as well in India, and essentially allow India to emerge as an alternative supplier to the rest of the world beyond China, which is, as you know, today is supplying almost 80-85% or more of all the clean energy equipment.
Yeah.
So I think that is the view that the Indian government has taken, and we've actually, as a company, been working with the government on making sure that we set up solar manufacturing within the country. And so we have now set up about 6.5 gigawatts of module and cell manufacturing capacities in the country at this point.
Sir, I was at the OPEC seminar in Vienna last week, and there are a lot of conversations being had about long-term energy and what that supply mix looks like. And many of the speakers there cautioned that if you move too quickly with the energy transition, you're going to imperil both energy affordability and energy reliability. And the takeaway is that hydrocarbons will essentially continue to be part of that mix. What is your response to that? Was the world moving too quickly on the transition?
I don't think so, Jumana. Right now, what's happening is that electricity today accounts for only about 20-25% of the entire energy mix. So it's a relatively small part. And within electricity, renewable energy accounts for only about 15% in most geographies around the world of electricity. So as a percentage of energy, renewable energy or clean energy is still a very, very small percentage. So to say that we are moving really fast in that transition, I think is really not right. On the flip side, if you look at what we need to do from a carbon emissions reduction standpoint, we actually need to move a lot faster, which is why at COP28, all the countries came together and said that we need to triple renewable energy capacity by 2030, which essentially we need to do. And we need to electrify the global economy as fast as possible so that we have more parts of the energy value chain moving to electricity. Now, if you look at India's long-term plan, by 2047, the expectation is that we will essentially electrify a part of the energy system from the current 17% to about 34%. And within that, increase the renewable energy mix within electricity from about 15-20% right now to about 50%. So I think those are the kinds of changes that we need, and we need to really move at scale if we have to bend the trajectory down in a way to keep the temperature change increase from being below 1.5, which seems increasingly unlikely, and essentially now below 2 degrees centigrade.
Yeah. You talk about the COP28 commitment to triple renewable capacity by 2030. What happens to that target, to that commitment, once the world's largest economy, the U.S., pulls out of the Paris Accords?
Well, I think it's something that we have a template for from the last time that the Trump administration was there 5 years ago. I think the rest of the world just carried on. And I think, of course, it's not great for the world's largest economy to be pulling out of the Paris Agreement because it is the second largest carbon emitter. And of course, it sets an example for the rest of the world. But I think what was very clear from the last time was that the rest of the world is going to be staying committed to the path of carbon emissions reductions and is going to stay committed to the path of whatever was agreed at the COP agreement. If you look at countries like India, for example, we have a pretty aggressive plan to move our energy system from the current system, which is based on fossil fuels, mostly towards clean energy, using things like green hydrogen, using nuclear, using hydroelectric power, and of course clean energy through renewables to fundamentally reshape our energy system. Now, I think that's the way of the future.
Yeah.
And I think countries that move faster in that direction, I think will be rewarded in the long run. And also keep in mind that countries like India actually don't have a choice because we don't have a lot of fossil fuels within our country. So it's a question of also energy security. And there's a very strong commercial implication because renewable energy at this point is cheaper than the alternative, which is fossil fuel-based power.
Yeah. Final Renew-specific question for you. A consortium towards the end of last year proposed taking the company private and delisting it from NASDAQ. Can you give us an update on how those discussions are going and the plans to delist?
Yeah, Jumana, because that transaction is ongoing and because I'm an interested party in that transaction, being a member of the consortium, it's probably best for me not to comment on what's happening right now. But I think if you look at the latest filings that the company has made, the consortium has made an offer, which is a sort of a final non-binding offer of a certain price. And I think the board or the special committee of the board that has been set up to look at this is probably actively considering that offer that has been made. So I think that's really where things are. And I think that the company will, in fact, update the market as and when things progress forward. But thank you.
Okay. I look forward to getting that update, sir. Thank you so much for joining us today on The Pulse. Sumant Sinha, Chairman and CEO of Indian renewable company Renew. Now, Wizz Air says it's suspending operations in Abu Dhabi effective September the 1st and wants to pull out of its joint venture there. The budget carrier has faced challenges, including engine maintenance issues and what it calls hot and harsh conditions, as well as geopolitical volatility and regulatory barriers as it tries to keep costs under control. And coming up, Donald Trump's allies seize upon a new way of criticizing the Fed Chair Jerome Powell, the cost of the renovation of the Fed's headquarters. Details next. This is Bloomberg.
Of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States.
That was European Commission Competition Chief Teresa Ribera speaking to Bloomberg. Now, the EU is said to be preparing to step up its engagement with other countries hit by President Trump's tariffs. Meantime, EU foreign ministers are meeting today to discuss progress on trade talks.
An idea of 30% tariff rate is effectively prohibitive to the mutual trade. We remain convinced that our transatlantic relationship deserved a negotiated solution, one that builds the basis for renewed stability and cooperation, and that is why we continue to engage with the United States administration and prioritize negotiated solutions by the new deadline of August 1st.
We're joined by Antonio Barroso, Bloomberg Economics Senior Geoeconomics Analyst for Europe. Antonio, so these EU foreign ministers are meeting today to discuss the trade talks with the U.S. But of course, the goalposts have just shifted. They thought they were working around a 10% baseline tariff rate. That is now shifted to 30%. How do we get back to 10%?
Well, that's exactly what the EU negotiators are trying to figure out. I think the problem here is that it's very difficult to know at this stage what Donald Trump actually wants. EU negotiators and US negotiators have been talking for weeks now, and they have been discussing very difficult concessions, especially on the EU side. So it makes it very difficult for the EU to essentially continue negotiating, but that's what they want to do. Clearly, Brussels doesn't want to engage in a escalatory spiral. There are reports that they were willing to accept a 10% blanket tariffs from the U.S. in exchange for some sectoral concessions. I think that's what they're going to aim for. But then, as I said, the main challenge is to know what Donald Trump actually wants. And a second challenge is, should the EU actually signal more forceful retaliation? Because, there is the short-term risk that Donald Trump might get even more angry and might actually make the negotiations more difficult. But maybe that's what you need. You need to retaliate, to signal that you will hit back strongly for the U.S. to actually give some concessions. So I think the EU right now is in a very difficult spot.
Yeah, and it's difficult also because growth is still at a very low level. You compare it to China, China is still growing at 5%. So there is a bit of cushion there and a fiscal cushion from China's part to play hardball. But speaking of China, there are also tensions between the EU and China. It's not just the EU and the US right now.
Yes, the EU is in a very difficult geopolitical position because there is a summit between the EU and China. This is expected to happen at the end of the month. And basically, the EU was expecting to iron out some of the differences that remain between both sides. But from the point of view of Brussels, China is actually not moving in some of the issues that concern the EU the most. For example, China has continued to support, according to the EU, the Russian war effort in Ukraine. And that's a very big problem for different European capitals and from the EU as a whole. But also, Brussels claims that China is not doing enough to stop overcapacity coming out from China, Chinese goods to be exported to EU markets and to flood EU markets. Several EU firms are worried by this, but China is not doing enough according to Brussels. So I think what you're going to get in the summit is a lot of words, but nothing actually to solve those irritants that really are a problem for the EU-China relationship. So the relationship is going to get worse, not better.
Yeah, and obviously a lot of attention as well on Europe's fiscal plans. Another story that caught my eye over the weekend, President Macron saying that he wants to double the French defense budget. Do they have the fiscal room for that?
Well, that's the question that everybody's asking. I think Macron has a very good point. President Emmanuel Macron of France has a very good point of promising to increase the defense budget. Is in line with the compromises and the different things that have been negotiated at the latest NATO summit. The question is, First, will he actually have a government in place to deliver such an increase in the budget for defense? You're going to have the budget negotiations for next year accounts now in October that will start. And there is very well the possibility that the government of Prime Minister François Bayrou might fall over the discussions on this budget. It's very difficult. You're going to have to increase the defense budget. And to do that, you can do three things. You can cut spending, which is not very popular. You can increase taxes. That is not very popular with voters. Or you can actually increase debt. That is not popular with markets. So it's not a very good situation for France in that regard. And in politics, we know one thing. It's very easy to promise things. It's much harder to deliver them.
Yeah, and as you're speaking, we're just showing some live shots of Bastille Day celebrations as they are taking place. So there is a picture of President Macron with his wife standing by, and others in attendance as well as we talk about Bastille Day commemorations. So there you have it, some pictures live from Paris. I do remember actually a couple of years ago he brought in a whole musical group to play renditions of Daft Punk. That was very memorable, if anyone recalls that from a few years ago. Anyway, that was Antonio Barroso, Bloomberg Economics Senior Geoeconomics Analyst for Europe. Now, UniCredit says it will assess the next steps on its takeover plan for Banco BPM amid doubts over whether the deal will go ahead following a ruling by an Italian court. The court struck down two conditions imposed by Italy on UniCredit to complete its bid. However, it left in place other requirements that CEO Andrea Orcel had previously said could halt his takeover plan. Now, there's lots of data out this week, which may give a sense of the impact Donald Trump's trade war is having on the global economy. First up, it's U.S. inflation data due tomorrow. Let's get more on what to expect with Bloomberg MLive strategist Ven Ram. So much going on in terms of data this week, but U.S. CPI is always the big one. And just looking at analyst expectations, most people seem to be expecting an uptick, both on core and on the headline figure.
Morning, Jemana. Good to be here, and great stuff out of Vienna last week, I thought. Look, I mean, I think the point of the inflation data that's going to come out for June is that there's going to be an uptick in inflation, as you mentioned. And I think that we are going to get inflation data out of the UK as well, day after tomorrow, and that's also supposed to show that inflation is going to be elevated. So basically, we are in a world where we are looking at 2.6 to 2.7% on core PCE, which will come out later this month in the US. And of course, inflation in the UK is elevated as well, 3.5% thereabouts. So all these factors suggest that, look, the terminal rates are kind of mispriced going into many of these markets, particularly in the UK, because I think that the markets are thinking that, the terminal rate could be lower than 3.5, which I think is unlikely because the inflation uptick in inflation is simply not going to give the BOE sufficient headroom to cut rates as much as they would like to.
Yeah, and meanwhile, President Trump and his allies are stepping up their criticism of the Fed chair, Jerome Powell, taking aim at his handling of the expensive renovation of the Fed's headquarters. It all coincides with Trump's relentless calls for the U.S. central bank to lower interest rates.
I think if Jerome Powell stepped down, it would be a great thing. I don't know that he's going to, but he should. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
So I saw a comment from Deutsche Bank's George Saravelos over the weekend saying that the market is underpricing or underestimating the real risk that the Fed chair gets forcibly removed or dismissed.
Well, I think Saravelos is absolutely right. I think the markets are pricing 2 rate cuts by the end of the year, which is according to the Fed median dot plot. But I think that the markets are underpricing that risk. Why do you say that? Because the Fed has got 4 more meetings to go. In July, they're not expected to do anything, but they've got 3 more meetings after that, September, October, and December. And if we get Powell as ousted, then I think there is a real risk that we'll get someone who's dovish and who's willing to cut rates as Trump wants, which means that 3 rate cuts is very much a possibility. And if you look at the Fed's dot plot, the lowest end of the range for this year was 3.6, which would tally with 3 rate cuts. And I think that the markets shouldn't be discounting that possibility.
Yeah, not least some questions about the central bank independence also, Ven, so perhaps bigger existential questions around the U.S. as well. Bloomberg MLife strategist Fenram, thank you so much for joining us on The Pulse today. But that was it for our show. Obviously, tariffs dominating the news agenda today as we continue to monitor the price action in European markets, most of them declining, led by the autos, tech, and consumer goods sectors. That was it for The Pulse. Up next, Bloomberg Brief. This is Bloomberg.